Today, I'm going to show you what $500,000 worth of trading mentorship has taught me as an investor. My name's Andrew Barnett and I've been trading for over 20 years now. And in this video, I'm going to break down the lessons that my mentors have taught me. These lessons are what took me from pro water skier to a pro trader. Look, I know that getting started with investing might seem daunting, and I know how important it is to get this right. Whether you need more money to be able to retire or you feel like you can never get ahead, investing is a great solution. But it's not easy to know where to begin, and let's face it, investing can feel incredibly lonely. 20 years ago, I was in the same boat. So I spent $500,000 on trading education. I learned from pro traders from places like Goldman Sachs and JP Morgan and BNP Paribas. I hired them to work for me. And in this video, I'm going to share exactly what that $500,000 of trading education taught me. In fact, over the last decade, I've taught over 4,000 everyday investors how to invest wisely and more profitably, thanks to the exact success principles I'm about to share with you. Okay, so let's get into it. The first success principle is knowing how to value a business. Hint, this has nothing to do with looking at charts. Valuing a business is not just about looking at the balance sheet to ensure its financial viability. Valuing a business all comes down to ensuring the company has a superior competitive advantage, a strong economic moat, ensuring the company is led by great management, preferably the founders of the business, and ensuring the business delivers high returns on capital and, importantly, is within your circle of competence. My second success principle, buy businesses at a discount. The average investor sells when markets go down and only buys when markets go up. The exact opposite to how great investors behave. Great investors recognize when a great company is trading at a bargain price. Great investors are eager buyers when everyone else is selling, and they are selling when everyone else is buying. They know human beings act like herds, and when the herd starts selling, they know this is the exact time that they can sit back and pick off great quality companies that are trading at heavily discounted prices. This is exactly what I teach my clients and is the number one reason why they're so successful. They know how to buy great companies when they're cheap. Now, if you have any questions on these first two success principles, then please let me know in the comments below. Okay, so my third success principle is this: knowing how to reduce risk. Managing risk is not just about buying something at the right price. Managing risk also comes down to ensuring the company you're about to own fits within your circle of competence and you have done due diligence on the company and the price you are paying is fair. For example, if you decide to buy a company for $20 and consider $20 a fair price, if the stock is trading at $15 8 weeks later, then the stock must now be a bargain and you should be buying more, right? But the average investor doesn't think that way. If they see price goes down, they think that maybe they should be selling, not buying. Great investors manage risk by ensuring before they buy a business, they've done adequate due diligence to ensure that if the price does go down, provided there is nothing wrong with the company, they are more than happy to buy more shares. You should never be selling a company just because the share price has gone down. Most traders sell right at the wrong time, and it's because all they do is look at price. They don't understand how to value a company and how auction-driven markets work. From time to time, incredible companies are trading at bargain basement prices, and I'll show you how to recognize this and buy them. My fourth principle is apply the right temperament. I truly believe that this is the number one skill in investing. You don't need to be smart to make above average returns. In fact, IQ has nothing to do with successful investing. Patience and having the right temperament is far more important than IQ. Successful investing is very simple. Buy great quality global growth companies, learn to recognize when they are cheap, ensure they are within your circle of competence, make sure they are led by competent management, and buy and hold them for as long as you can. Buying and selling for quick profits and jumping in and out of stocks is a surefire way to drag down returns. In fact, you will make a lot more money over time by simply sitting on your backside and doing nothing once you own a concentrated number of high quality companies for your portfolio. Now, I hope these guiding principles are useful for you and help you as you get started on your investing journey. I truly believe that following these principles will yield really meaningful returns on investment over time for you and your family. Investing might seem like an intimidating task, but hopefully you can now see that it doesn't have to be if you know the right way to invest and if you follow the smart money. If you have any questions, pop them below, and don't forget to like this video if you found the information I shared today useful. And of course, please subscribe to this channel as I have more great videos coming. Thanks so much for watching.